The main objective of financial accounting is to provide information to stakeholders in a company. The Financial Accounting Standards Board suggests this information contain two fundamental qualities: relevance and faithful representation. We will discuss how faithfully represented and relevant accounting information is used by external stakeholders of companies. Who are stakeholders? A stakeholder is defined as a person with an interest or concern in something, especially a business. Stakeholders can be employees, customers, managers, investors, banks, suppliers, towns, states, countries, and even entire global populations. Stakeholders are usually broken into two groups: internal stakeholders and external stakeholders. For this video, we want to focus on external stakeholders. In particular, we want to answer the question, how do external stakeholders of a company use information from financial statements to make decisions? Since we are concerned with external stakeholders, let us consider 5 different types of external stakeholders and answer that question for each one. The external stakeholders we will consider are banks, investors, suppliers, customers, and even competitors. Let's start with banks. Banks work by storing other people's funds and lending those funds out to organizations that need capital. The main goal banks have with their money is to make more money by lending it at a higher interest rate than they pay out to their depositors. That's called the spread. When a bank makes a loan to a company, the bank expects the company to be able to pay the loan back to them over time with interest. Like we said before, banks make money on the spread between the interest the company pays them and the interest the bank pays their depositors. Banks use financial accounting statements to determine if a company has the ability to actually pay back a loan. Before making a loan, the bank wants to confirm the creditworthiness of the company to ensure they will get their money back. One way they can do that is by looking at a company's balance sheet to make sure the company has liquidity and will remain solvent over time. Let's talk about investors now. What is an investor's goal with their money? There are different types of investors. There are short-term investors, long-term investors, environmentally conscious investors, investors that want to help create the future through technology advances. At the end of the day, though, every investor wants to see a return on their invested capital. Investors give money to a company in exchange for ownership of the company, known as stock in a company. We know that the value of a company is contained in the present value of all future free cash flows. Therefore, the investor is exchanging their capital for a piece of the company's future free cash flows. The investor makes money by either selling the stock for more than what they bought it or through dividends. If investors could tell the future, they would know what price to pay for stock in a company. Since they do not have a crystal ball, they use financial statements. The statements tell an investor about the company's past, and the investor uses information from income statements and balance sheets, along with other research about the economy and trends to choose whether or not they can obtain a return on their capital for the company in the future. Suppliers are an important stakeholder in a company. Without suppliers, a company would be unable to produce their goods. To suppliers, a company is one of their external stakeholders in the form of a customer. A supplier's goal is to provide a service to their customer, our company, and to receive a profit in exchange for that service. The main thing that a supplier is getting from a company is cash, in exchange for the product or service the supplier provides. A supplier has invested their own capital into providing the good or service to that company. They aim to make a profit by supplying that good or service to the company. Suppliers look at their customers' financial statements to know customers can pay them. For small purchases, the supplier may just need to know that the customer has enough cash on hand to make the purchase, like when a restaurant purchases ketchup at Sam's Club. For a larger purchase, like a shipping company buying a tanker, the shipyard may dig deep into the company's financials to make sure they have the financing ready to be able to buy the ship. Speaking of customers, they are a very important external stakeholder to a company. In fact, without customers, companies would not exist. So what goal does a customer have with their money when they spend it with a company? In general, the customer is looking for an exchange of value, their money, for the company's good or service. It bears repeating, their money for the company's good or service. The customer of a company is looking to obtain something of value from the company in exchange for their money. The customer earned their money through hard work and dedication and are justified in getting the most from their dollars. Companies battle one another to provide the best value for their customer's dollar, whether in exchange for poetry readings online, knee surgery, or a car. Customers use a company's financial statements usually for large purchases. When looking to fill a big contract, a customer wants to make sure a company can remain in business throughout the entire term of the contract. This is known in accounting as the company's ability to remain a going concern. If they do not think a company will remain solvent, they may choose a competitor. Competitors. Competitors are external stakeholders in a company as well, though competitors have a different interest in the company. They have an interest in outperforming the company and obtaining better returns on their efforts than the company can itself. A competitor sees a company and its marketplace niche as a threat. A competitor to a company wants to eliminate that threat to their financial resources as quickly, effectively, and efficiently as possible. For example, an orange seller at a farmer's market does not want another orange seller to set up shop, driving down prices and profits. Our competitor orange seller in the example above would use the new company's financials to determine how vulnerable they were to competition. Maybe they are not very liquid and a temporary price cut could force them out of business. Maybe the total value of their company is low enough they could be bought out. Whatever it may be, the competitor will review the company's financials to achieve Sun Tzu's goal of knowing thy enemy. Companies spend a great deal of resources to track and prepare financial statements. This financial information is of course very important to the company's decision making, but that information is also important to the external stakeholders who are seeking to make optimal decisions with their money as well. And the sum total of all those decisions is what keeps the economy going for everyone.